Good afternoon, everyone. I am David Scherer, co-CEO and co-founder of Origin Investments. Many of you, I probably were on our predictions webinar 2 days ago, so I hope you're not tired of seeing me this week. Today, we are covering QOZ 3. We have some exciting updates there for fund investors, and that fund, we'll talk about it in more detail, but it'll be open for investment through the end of this year. I'm joined today by Jacob Sojka, who runs equity for Origin and all of the West. Jacob joined us, I want to say in 2017. He's been with us 8 years, initially as an analyst, and for the past several years as a deal officer. I think you'll find him incredibly impressive. I certainly do. So the format today is I will start with a macro on the fund. By the way, I'm not going to cover macro trends in multi. I feel like we've covered that on other funds. If you have questions about underlying demand drivers, supply drivers, capitalization rates, interest rates, any of these, cover them in Q&A or just shoot me a note or Jacob a note, and we can always answer your question offline. I just want to be respectful of your time. So I'll jump in with a macro on the fund only. And then we will talk a little bit about the three deals that are either in the fund or we're very confident will be in the fund. And then we'll open it up to Q&A. And I think the goal is to have 1 hour. So maybe 35 minutes of presentation and 25 minutes of Q&A. Just a little bit of housekeeping. The Q&A box, you can probably see it, but it's on the upper right. You just hit the menu and scroll down. All right. So the QOZ 3 fund obviously is a multifamily focused fund. That's all we do at Origin. So anything we do in credit or equity, in this case QOZ, which is a subset of our equity portfolios that we create for investors, will be multifamily. And the longer I'm in this business, it's approaching 20 years now. I do have to say multifamily means large rental housing in the U.S. It tends to be above 150 units. Probably the median is about 250 units, our average deal that we develop or purchase, operate, or lend to. You'd be amazed. I have some meetings, and then at the end, someone will say, "Oh, do you know what multifamily is?" And I don't know what that is. So I'm just trying to get out of that. This will be ground-up development. All of our QOZ funds have been. That's in part to comply with the law, but it's also in part just to generate the returns that we think are commensurate with the risks of what you're doing here as an investor. The 10-year hold period. We'll get into the rules of QOZ just briefly, but we're required in the investment cycle of developing, stabilizing, and then renting it to hold the asset for 10 years to get the tax benefit, which is the elimination of the new capital gain that's generated. So this fund will be no different. That 10-year period is measured after the last equity is accepted. So it'll be 10 years from December 31st of this year, which will be the final close as well. The target net IRR simply means what you are earning net of all fees and promote. So that's what comes to you is 10 to 12%. That's our target. And that's over a 10-year period. Which is quite high, actually. An IRR that of 10 to 12 is pretty high for a hold that long. IRR is a function of both the return generated and the time span. And then the multiple is really where I think you should focus as an investor. Our target net multiple to you is 225 to 2.5, simply meaning if you were investing $1 million into the fund, after 10 years, we would expect it to be worth 2.25 million to 2.5 million. The gain, of course, would be 1.25 to 1.5. The million is what you invested in its return. Net multiple is at least the metric that I believe is by far the most important when you're evaluating the efficacy of a fund. In terms of origin, we are a top 2% QOZ fund manager. That's measured by Novogradac, who's one of the industry leaders in that space. They're measuring it by the amount of equity raised and deployed. Our first QOZ and second QOZ funds each were around 300 million of equity each. This is our third in that space, so we're considered a leader in that space. In a moment, Jacob's going to go into much greater detail on the deals that are either in progress or under control at this point by the fund. You can see that it has lots of geographic diversification. These are all markets that we believe in, and our AI modeling, Multilytics believes in terms of their short-term and long-term growth rate, measured by rents, of course. We're going to get into more detail on each. Two Rivers is a deal we will be developing directly. And that also has a lot of benefits to you. And just in terms of efficiency, you're saving quite a bit having Origin be the developer. This graph it's quite interesting. Blue is bad, red is good. So think of blue as ice cold and red is red hot. That's the CAGR, or the compounded growth rate. That's what Multilytics, our AI that's been extraordinarily accurate over the last 5 years, is predicting. This is a specific sub-market analysis of Phoenix, and I've covered this on prior webinars, but when we look at a city, this is a great example. Phoenix isn't a city we cover. We cover certain submarkets in Phoenix, and we do that both through Multilytics, such as this map you're looking at, but also through the acumen of our deal officers who live in these regions and understand where growth will be. And it really is both. Jacob actually covers this market, so perhaps he'll talk about that a bit. But interesting enough, Madera at Old Town, it's in Old Town Scottsdale. I'm familiar with Phoenix. Phoenix is, it's a series of submarkets, but I would say Scottsdale is the best if you had to pick one. And Old Town Scottsdale is sort of the best within the best. This speaks to another point that's interesting, and I'll cover it on a subsequent slide. This will not be part of QOZ when it's remapped. So this is truly a moment in time. You will have an opportunity to get into a deal like this for the next year, and then it'll change. And I'll cover why in a moment. But the big point here is Multilytics is generating. This is just a visual, because this it helps in a presentation of a visual, but it's using billions of pieces of data to come up with where it thinks we should be investing for long-term compounded growth, and that's what we're looking for in this fund. This slide, I'm gonna move through it somewhat quickly, but it's comparing the old QOZ law to the new QOZ law. Lots of the Trump tax extensions, the beautiful bill, it simply extended the tax cuts that happened in 2017-18. In this case, QOZ actually changed. It wasn't just extended; it was extended, but with changes. And so it speaks to kind of where we are per se. And so the old law was set to expire, meaning you weren't going to be able to invest new QOZ capital after December of this year. Of next year. And the other part of the law was you couldn't, anything you invested today, you could only defer the original capital gain until December of next year. And so as you can imagine, when the law first, and we were doing this, we were investing in 18, 19, 20, you were able to defer your capital gain, your original one, initially 8 years, then 7 years, 6 years. It was very powerful. Now that effect isn't very powerful because you're only deferring it a year. The new law, which actually doesn't start until January 1st of 27, so think about it now, just over a year. There's going to be permanent 10-year cycles, meaning the law will be extended 10 years and then it'll be looked at again and again. The deferral, I'm jumping all the way down to gain deferral, which is the fourth bullet on the left. Law 1, I already covered this, 12/31/2026, but going forward, it's a 5-year rolling deferral. So lots of people are interpreting this change and they're saying, well, I don't want to invest in the QOZ now because I'll only get a year deferral of the capital gain. I'm going to wait because I'll get a 5-year deferral. And that's true, but there's something that might be more powerful that you're missing, and that is they're going to remap. And so if you think about the mapping, and the mapping, I believe we have another slide for this. No, we don't. Thought we did. Doesn't matter. The mapping in the initial law was based on the 2010 census. And the 2010 census, if you can imagine in these cities, just pick Phoenix, but Nashville, Denver, Charlotte, I mean, these are rapidly changing cities. So as we sit today, the mapping is still based on the 2010 census. That's why, but this Old Town deal in Old Town Scottsdale, that's why it's still a QOZ deal. When it's remapped, and to be clear, the remapping will happen January 1st, 2027. So when the remapping happens, this will no longer qualify. And so in my opinion, you do get the benefit of a longer deferral, but you're giving up an enormous benefit of QOZ maps that are drawn. It's not that they were nefariously drawn. It's just, it was a different world. You're talking about 15 years ago. Very, very different world. We were just coming out, just to give you an idea of, the level set, that was just coming out of the Great Recession. Real estate was much, much lower in value at that point. Cities were very, very different at that point. And that's similar. Jacob will cover our Two Rivers deal in Florida, in Tampa. There's no way that would survive a remapping. The homes around it they're worth way too much. And one of the things that's going on with the new law is they've been much more stringent about what they're calling the area median income. And so right now, not only are you benefiting from the fact that the 2010 census and cities have changed, but it was, to qualify, you only needed 80% of the area median income. Going forward, it's 70%. And so, in other words, it's going to be in even less developed, more low-income areas. And that traditionally, unless you have local subsidies, it's very, very difficult to make those deals work from a capital standpoint. So we believe that it's going to be very difficult for that to work. Not impossible, but you're going to need the municipalities also to be providing TIF or tax incentives to make, we need to make 20% on our money in the development phase. I'll give it a range, but that's what it needs to be. And if the rents are quite low, there's only so cheap you can build something. And so the equation just doesn't work. If you have questions about this, we can handle it in the Q&A. The big picture here is you're going to get a longer deferral, January 1st, 2027. That's good. The bad is you're going to be remapped. And most of the sites that we've been working on for quite a while, and we pass on an awful lot of deals. 50, 100, pick a number. Not many deals even work into the old maps. So it's going to be very difficult under the new mapping structure. So is QOZ 1.0 still worth investing in? I think I covered this. The answer is yes, it is. You're still getting the biggest benefit, which is the elimination of the second capital gain, the one generated in the 10-year hold. You're still getting the benefit of depreciation of the asset that doesn't ever get caught up. So once you build a QOZ asset, you can depreciate it against earnings every year, And normally that's caught up when you sell the asset because the basis keeps going down through depreciation. But in QOZ law, there is no catch up. There is no capital gain at the end. So it's free depreciation. That's pretty extraordinary offset. And that's another benefit that remains in QOZ 1 and QOZ 2, for that matter. But the biggest benefit of QOZ 1 is you're still getting the 2010 mapping and the 80% median income requirement, 80% of median income. And that's a really powerful benefit. With that, I'm going to turn it over to Jacob. I actually was on time. If anyone was on the predictions webinar, I was way over, but I wasn't today, Jacob. He's going to cover 3 deals, and then we'll circle back with Q&A.
Awesome. All right, I will jump into the deals specifically here one by one. So for quite some time, our acquisitions team has been working diligently to ensure we find opportunities in the QOZ space to make this diversified fund. So I'll walk through the 2 new opportunities today that we're very excited to talk about. And first, I'll just touch on the deal that's currently in the fund, Biltmore Village. So a huge amount of progress has been made both on the village as well as the project since the last time you all spoke with Dave. In order for the village to really restart and making strides on its rebuilding, from Hurricane Helene, the city needed to finalize a lot of new electrical and civil requirements for the area, as well as settle just a number of insurance claims. As of today, a lot of those steps have largely been completed. So roughly 80% of the retailers and hospitality operators in the historic Biltmore Village District are now underway on their rebuilds, which is pivotal for restoring foot traffic and supporting local employment. So for example, the Williams-Sonoma was right down the road from our site. That's almost ready and going to open its doors for the holiday season here. So I think just a tremendous amount of progress has happened for the village itself. For the project itself, there's been a lot of momentum progressing on site. So the townhomes are all fully roofed. Framing is ongoing for the multifamily. The parking deck is being poured currently as we speak, and the buyout's fully complete, so really mitigating a lot of tariff risk. So all in all, the project and as well as the surrounding areas have been making great strides, and a lot of momentum is building in that submarket. So I think the rebound from Helene has been really steady over the last few months since the last update. So the first new deal that I want to talk about that we're currently in diligence on is Madera Old Town. So as Dave highlighted previously, so this project is located right at the heart of Old Town Scottsdale, at the corner of Scottsdale Road and Indian School. This is one of the highest barrier to entry locations in Phoenix as well as across the country. The site's walking distance from several million square feet of retail, offices. It's making it just a super dynamic location. This is one of those locations that's a needle in the haystack for QOZ, and really unicorn and very hard to repeat, not only in Phoenix, but just anywhere across the country. So we're very excited about this opportunity. We'll be partnering with a repeat sponsor, Mill Creek, on this one. Our first deal with them, and some of you may be in it, in Madera Gilbert, which is a submarket of Phoenix, has gone great. So we're excited to round trip another one together. From a returns perspective, this deal has a few aspects going for it that I think also make it very unique on top of the location that we talked about. Our mill rate here is 20% lower than the Phoenix average. So Phoenix, compared to all of our markets, has probably the lowest, if one of the lowest, if not the lowest property tax burden, for the markets that we cover. This has a mill rate that's 20% even below that for, already low expectations and standards for Phoenix. So I would say that, coupled with just the high rent profile that Old Town commands, because so many people want to live there, make the yield on this, at a 6.2 and above, very attractive. So our main rent competitor, which is right across the street, Scottsdale on Main, actually just sold as well for a 4.5 cap rate. And I think really speaks to just the strength of location that it can command that sort of price, even in a weaker capital markets environment. And, going back to, when Dave's talking about that we need a certain margin on a deal in order to move forward, if holding those things constant, with our 6.2 return on cost and market cap rates in this area trading at a 4.5, that puts your margin going into ground in excess of 30%. So that's about as good as you can ask for a development risk profile. So overall, this is a very unique opportunity, and one of these tracks that will not be available in QOZ2, given how far the incomes have developed in this area. So I think this is a perfect example of a QOZ1 site and deal that you'd want to take advantage of. All right. And then last but certainly not least, so for the better part of 2 to 3 years now, we've been searching for QOZ deals that offer both compelling return profile as well as diversification for Fund III, as I mentioned before. As of today, we've found very few that can hold the merits of the 2 previous deals that I talked about, as well as Two Rivers, which is in Fund II QOZ. So Fund II, I think from our perspective, doesn't have the capital currently to take this deal vertical, which is, I think, why we've collectively made the decision that Fund III would give the balance to make this deal go vertical. And again, as Dave reiterated, we evaluate hundreds of deals across the country. So this is not a lack of opportunity, but more so what I would say is a lack of quality on the new deal front to find deals of this caliber, as well as Old Town, as well as Biltmore Village. So we believe Two Rivers is in the same class as those 2. So for those who are new to this deal, that have not seen it in Fund II, this is located in a master plan in Northeast Tampa. I would say in a period of time where home sales are slowing just across the country, the Taylor Morrison community, which is one of the main components of this master plan, has sold over 1,200 homes in the trailing 12 months for prices that for a lot of homes are in excess of $1 million. So it's a pretty unique master plan community from that context. And then as well, there's over $1 billion of development ongoing in this master plan related to 2 Publix anchored retail centers, hospitals, as well as a golf course with the same designer as Bandon Dunes. So it's a really high quality master plan. It's not one that's being run by a home builder that's just trying to slap homes all over. It's really thoughtfully done. And I think more broadly, the project is located in Pasco County. Pasco County ranks in the top 3 U.S. counties for net in-migration. They add net over 25,000 residents each year, with average incomes over 130,000. So getting back to what Dave's talking about, there's no way this will survive QOZ2 census tracts when they realign, both for the new median incomes as well as lowering the threshold from 80% to 70%. So I think this is another high quality site with great margin to take advantage of before these tracts sunset. And I think the additional benefit is this site is pretty much shovel ready. So I think from an elimination of cash drag for the fund, it'll buoy the fund from that respect as well. So I think it's another great opportunity. Really excited about the new 2 additions, as well as Biltmore. I think great things are happening on that current deal. So without further ado, Dave, if you have anything else, we can jump to Q&A.
Awesome. We're ahead of schedule. I'm going to tell just a really brief story about Two Rivers. I was just there with our lender on the deal, and a potential investor in the QZ3 happened to live in Tampa, and he met us there as well. This is 2 weeks ago. He also, I'm not going to name him, but he's the former CEO of a multifamily real estate company that specialized in Florida. So I was interested to see what he thought, and he is now an investor in the fund and the deal, and he just, like, you have to go out there to see the level of growth and what's happened. This is an example of the land that when we purchased it, we got at a great basis. even in, it was purchased in 21, 22, I believe it was 21. Those were times where a lot of the land was overvalued. In this case, it wasn't. We've actually received offers way above what we paid for this land. And so, some of the questions that we might get, I don't know, I'll preempt them, is, how are you valuing the land? How is this happening? And first of all, we always use external valuations with all of our funds. We don't do that anymore internally. We just, even though we think that we're very fair, it's just best practice not to do that, so we don't. In this case, we have offers that substantiate that, but we're transferring it into the new fund. In other words, the QOZ fund itself will go in at basis, meaning what was paid for the land plus the improvements on the land. Since then, we've actually been working on this deal for over 3 years at this point. The last thing is we'll be developing the deal ourselves. Origin has a very large and experienced development team that we leverage both for joint venture opportunities, but also direct. We do both. And we have the ability to do both. QOZ 3 benefits from that significantly because there's no development partner that it has to pay. Origin doesn't charge you additional promote or fee sharing, if you will, profit sharing, because we're developing it. We're not doing that. And so, you're getting a significantly more share of the profits because we're doing that. And so that's another benefit. All right, I'm going to move to Q&A. And Jacob, why don't you, I believe we started with the emailed in ones, but we have extra time. So let's start with those. Let's start at 1 and we'll go right through.
Excellent. All right, I'll scroll down there.
I'll do the first one then. I'm already there. So how much has QOZ 3 raised to date, and will it move forward? Absolutely. I don't have that number. And this individual did not say their name. We can make that available. So if you want to email me back and let me know. But we will raise, another question we had is, we'll raise through the end of this year. We're not going to extend that date. And so based on how much capital is raised in the next 4 weeks, that will determine how many more deals the fund does. And the reason we don't want to extend the date is what I said earlier. If we extend the date, then the people that are in the fund, their 10-year window doesn't start. And so the longer that date is extended, the longer that 10-year window goes. And we feel it's not fair to the existing investors. So we won't do that. But we'll get back to you with the total raised at the end of this year, and then the strategy around how to invest that capital.
Just on number 2, I think we answered on the status for the Biltmore Village, but just to reiterate again, I think the village is 80%, on its way to being rebuilt currently, with the balance of the 20% that will start their projects near term. So I think the rebound, though it took a lot to sort through more administrative aspects with the city, as well as insurance claims, has really gone well, and it's started to hit its stride. And the project itself is, as we talked about, fully bought out, has the vast majority of their contingency still remaining. So with no tariff exposure, really left. That was something the GC really took on themselves. So I think all in all, really great positioning for Biltmore Village.
When is the earliest date we can withdraw funds that are exempt from capital gains? That would be 10 years from the last dollar accepted. So it will be 10 years from December 31st, 2025. That's when we'll stop accepting. There will be, and this is another question we've had, we expect, I should say, because it's based on market conditions, but we expect that there'll be distributions from cash flow after the development period. So that would be, in my opinion, years 4 to 10 that you can also expect. But in terms of us selling assets so that you can receive large capital distributions. And then the other way you get capital back, which is also exempt from capital gains, is through refinance. Those would happen also in years 4 and 5 as you come off the construction loan. I won't provide a range of what those would be. I can tell you what they historically have been, but we've been in a very volatile interest rate cycle, and so I really don't want to be on the record saying that, but I would say historically you do get returns from refi and cash flow.
I can handle number 4, Dave, if you're good with that. So from a vintage on this fund specifically, I know Dave has talked a lot about it on previous webinars, and I'm assuming on the predictions webinar as well. I think there's different vintages of funds that, I would say that are more sector wide in how they perform, right? Whether it's, asymmetrically upwards or downwards. From the discussions that, Dave and I have, there's this very cliff of supply that's happening, right? Where we're still kind of working through the final stages of the final supply wave that we're in. But after that, there's really very few, I would say, and limited new starts, as well as a lot of the operations pieces, finally for multifamily after 2 years of being a little bit choppy, are going to start going our way. And then you couple that with construction costs on, a host of the projects that we're going into ground with are coming down pretty dramatically, anywhere from 5% to 10%. So what I think this fund sets up, just based on when these deals are starting, I think they're going to be starting at very opportune times to take advantage of the retreating construction cost market, as well as on the other side, taking advantage of, what will hopefully be a lower supply, higher rent growth, operations market on the top line. So I think from a fund vintage perspective on Fund 3, I'm very excited about it, as well as just the high quality nature of all these deals. But Dave, I don't know if you have anything to add to that.
I would only add, and I covered this on the webinar 2 days ago, the probability of construction costs going up next year is quite low. And that's based on there's just not enough starts in multifamily, and the GCs and subcontractors really need work. And nothing's certain in investing, but I will say objects in motion tend to stay in motion. And the motion right now is towards deflation and construction costs. Like when we go to bid projects, and that's the benefit we have. We have 14,000 units in some form of development, whether it's pref, common, QOZ in this case, but also market rate. So we have a huge information set. And what we're seeing is when you actually have debt and equity lined up, and you can go to subs and GCs and say, look, I need you to sharpen your pencil, you're getting another 3 to 5% off. So like, in other words, off a flat line. So you had a flat line bid, meaning no inflation in construction costs. And then in the final iteration, it's actually savings over last year. So I'm only saying this because in any development fund, there's 5 variables that matter. Construction costs are one, and I'm telling you, I don't see that as much of a risk for next year. That's the important year for QOZ 3, right? Because these next 2 deals, Biltmore has started, but the other 2 haven't. And then the others are obviously interest rates. My belief is we're range bound, and I'm not going to be redundant with what I covered before. That's covered in detail in this other webinar. Cap rates, I think, are range bound. They're largely a function of interest rates, also growth. And then, of course, rents and operating costs. Rents, we believe, if you look at a rent equation, and this is what Jacob just said, it's always a function of supply and demand. We know supply is going down a lot. New supply will not happen. In terms of demand, we're set up, to have a demand that I believe is flat. But listen to what I'm saying, flat from an all-time high. We're at all-time high demand right now. And so for me to say flat remains, demand remains flat, that's a very good thing, actually. So I like the vintage and where we're set up. amongst these five variables. OPEX is the fifth, and OPEX is also flatlined, mainly because insurance probably was overdone in 22, 23 when they were repricing, and now it's actually flat to negative. And so, that was the big shock in OPEX, and to a lesser extent, payroll. I'm going to move on. Maria, this isn't Maria. This is our another question. What is the potential for value-add QOZ projects? For us at Origin, we won't do that. It would be difficult to improve a building by the basis and qualify. Probably not impossible, but we don't even look at those deals, so that's not going to be what happens here. And the other question is, will the move to rural QOZ sites, because you get a 30% reduction of your original capital gain if it's a QOZ rural in the V2 of this law. The question is, will we do more rural, ex-urban, smaller projects? And the answer is no. Our job is to make you money. And then, of course, the next job is to make sure we comply with QOZ so you don't pay any taxes on the money. If we don't make you money, there's no taxes to pay anyway, right? And so when we look at a site that's rural for multifamily, I find it hard to believe there's enough demand for renters to fill that at the right price to pay us. The other problem is the more rural you invest, the less liquid your exit. We want to be in markets that have lots of transaction volume so that we can refinance and we can sell. And if you think about the markets we just talked about, those are the attributes they have. And you'll always see that. So the answer is no, we won't be chasing the small rural sites. Go ahead, Jake.
Got it. I think you covered number 8.
Yeah, just move on.
Yep. I'm just going to the next one.
9 isn't relevant, so move on to 10.
Yeah, that's what I'm looking. On 10, I think the short answer is yes. I wouldn't say transfer the assets into the fund, but from the sales. You have to raise
a question, Jacob. I'm not sure the audience can hear. They might.
Okay. Sorry, this is just a little bit lengthy. So if they have clients that are selling their business and experience capital gains, are they able to transfer the assets into the fund and avoid capital gains taxes? They won't be able to transfer the assets.
This question, it's sort of an idea of an UPREIT. Like, if I have an asset, can I transfer it into the fund? And the answer is no. You need to sell your asset to generate a capital gain, and then the capital gain itself is reinvested into a QOZ. You can't exchange your asset for shares in the fund. That's how I'm reading it. So it's a little bit of a nuanced question.
Yep. I can do number 11. So with regards to the risk reward, how does the 5-year outlook for QOZ development compared to that of the general multifamily development? From my read on this, I think they somewhat flow together. We don't do deals in QOZ that we wouldn't do in a just traditional, multifamily development fund that we're doing. So, like, for example, Select Asset Fund, they have to comply with QOZ laws, but that real estate has to hold the merits of any other deal that we would do. So I think the outlook for them from a multi perspective is very similar, but obviously you get the added benefit of the QOZ treatment on top of that. So I think they will flow very similarly just because we select, the same opportunity set, but then you just get the tax treatments as an added benefit on top of that. So I think both very good, and then QOZ just gets the leg up.
100%. We view QOZ deals with the same lens as a market rate deal. In fact, a lot of our QOZ deals and our funds, market rate funds would want to invest in. They're not even getting a tax benefit. They just like the site. And that should make sense because QOZ 1 law, you're investing in oftentimes the best parts of these cities. such as, the Old Town Scottsdale deal we're talking about, or Two Rivers in Tampa, et cetera. And so we view them identical. We don't use a different discount rate per QOZ. Next question, are you deploying the OZ funds this year, next year? We're deploying these funds as soon as possible. And so that's one of the benefits of investing in QOZ3 now, is you're going to have a very, very shallow J curve, meaning we're not looking for deals. We have the deals and they're starting. And so that usually bodes well for investment returns when you can put your money to work faster. Next question, are there distributions paid during the whole period? Yes, there are. But I have to also tell you, and I tried to say this earlier, it's theoretical, right? So in our models, if interest rates stay where they are now, and we're able to develop to the margin that we believe we will, there will be distributions from both refinance and cash flow from operations. And that happens years 4, 5, 6, 7, 8, 9, 10. The nice part is you can use depreciation to offset your dividends, which is great. That's normal in real estate. But what isn't normal is you don't ever catch it up. So it's a free tax loophole of the deal. I think we have 15, Jacob.
Mm-hmm. For options, for gains that will occur in 26, we are closing fundraising, I believe, Dave, at the end of this year. So, I think from that perspective, this would have to wait, unfortunately, for 2.0.
Or another thing you can do, if the gain, if the gain is from real estate, we have a really interesting 1031 program here. And so if it's a real estate gain, you should talk to whoever's working with you at Origin about our 1031 program. We've become a leader in that space, and that's a cousin of QOZ, but it's only for real estate gains. If it's a general gain, remember, you have quite a long time. Once you sell, you can redeploy into QOZ. So it depends on when the gain is taken as well. If you're interested in QOZ, it could be that we launch a fourth fund in 27, and it could be it sooner than that if there's real demand that's shown for the program. 17.
Yep. Is this QOZ? Yep. Is QOZ 3 opportunity about as good as it gets from a vintage perspective, and could you compare it to the other QOZ vintages? So first piece first, as I was saying earlier, I think yes. I think just this development cycle is one of those ones, a classic Dave term that you want to get in the way of, just because you have a lot of these 5 variables that are starting to turn positively and going your way, for the first time in 3 years. So from my perspective, absolutely. I think comparing it to the other vintages, I think the real estate will obviously be very different, between the 3 different funds. So I think you have to probably do pros and cons of those. But I think from an overall vintage perspective, we're not in the inflationary environments that we were in with 1 and 2, and the supply woes that 1 and 2 are facing right now. On the operations side, will not be happening when QOZ3 is in lease up for those assets. So I think a lot of the, I would say, more market driven issues that are happening with 1 and 2 won't again, I think what we can see today will not be a reality for Fund 3, would be my perspective there.
Okay, I'm going to jump to question 20. So we've already answered those others. This is live now, so I'm going to start naming the name. Manan asked the question, sorry, I missed the first 10 minutes. Are the pipeline deals previously shown in Q1 and Q2 still being pursued? For example, Austin. Well, I'll answer your question specifically about Austin. Austin has been put on hold for now because it's not meeting our margin of development. So I would say that's unlikely to be in the fund, as an example. But it's also indicative of how many deals, when we speak to this, how many deals we look at and how many deals we work on for long, long periods of time. And so I would not expect Austin to be in the fund. So the pipeline we're representing of these 3 deals is current at this point.
I think 23 next, Dave, for Farhad asked, which structural construction systems methodologies are planned to be used in these projects? So for Old Town, that is going to be a podium style construction project. Given how urban and how dense Old Town is, that's the only way that you're able to deliver for, in an area like that. And generally speaking, those are higher basis just because it involves a lot of concrete as well as subterranean work for those projects. So if we are doing one of those projects, we're very mindful and we want to understand how much of a margin and spread that we have to prevailing cap rates today. And I think that's one of the reasons why we don't do podium very often, because it's hard to achieve those margins. But Old Town is one of those, I would say, again, needles in the haystack where we're able to get that 30% margin day one, from everything that we can see today. So, but for the other 2 deals, and what I think specifically for Two Rivers, since that's going to be going in, that is conventional garden product, which is much more, I would say, down the fairway for what we do on that front.
Okay, I'm going to skip to 25. Rob McCourt. Thank you, Rob, for your question, for being such a great partner. What will the impact be to rents, given the productivity gains and potential job losses from AI? Job loss will most likely be from white-collar jobs. So, again, I don't know, Rob, if you attended 2 days ago. I talked about this quite a bit. It was actually my first prediction. I can tell you my opinion. My opinion is, it's not clear to me that statement's true. I mean, for one, it might be. If you made me guess, I think that phase 1 of AI, when I say this, I'm making an assumption. I'm making an assumption that AI is adopted broadly and successful, and the companies get the gains that they think out of it, right? That's an assumption in itself. But assuming that were to happen, I think phase 1 would be net more job losses than jobs created. And I think phase 2, which probably is a 3 to 5 year period, probably phase 1 is 1 to 3. Phase 2 is even less clear there. Traditionally there's been innovation that comes with these step functions that create jobs. Certainly the internet's an example. So it's not clear to me, the statement itself, but your point is not incorrect if that's your assumption, Rob. If your assumption is AI is going to be successfully created, it's going to be successfully created quickly, and it's going to be adopted broadly, and it's going to be successfully adopted, for you to come to the conclusion that white-collar job losses would be a net result is a reasonable conclusion. I just don't know if that's correct in all of your assumptions. So it's difficult for me to speak to that. That's my answer. I'm sorry. I don't have a better answer.
I think 26 next, Dave, for Manon is 3 projects enough diversification for QOZ 3. I think from my perspective, if I would have more concern if they were all in the same area of the country, same or even same markets or same product type as well, or if they were all in the same risk profile of being, I would say if we were looking at QOZ 2, right, if all 3 of your projects are these rural ex-urban projects, whether it's in, ex-urban Phoenix or ex-urban Chicago, wherever, that is the same element of risk profile. I think what we've done here is not only diversify geography, but also diversify area within those geographies. One is incredibly urban, high barrier to entry, and then, with Two Rivers, right, it's suburban, also high barriers to entry because there is a moratorium in that area of Pasco County for new multifamily units that we are grandfathered into. But it's a different execution on a sale where, you won't have groups that will be mindful of a basis and for 340 or 350 a door, type of execution versus Old Town will sell closer to 600 or 700 a door. So I think there's a lot of different diversifications amongst those three. But Dave, I don't know if you have anything else to add there.
No, I don't. I think the fund is well diversified for the equity that has been raised. And so I think you're getting the benefit of three really high quality deals in different states and regions. If more equity is raised this month, we'll do a fourth deal. So that's where we are. Daniel asked a question. This is a great question because it's clarifying. I appreciate it. When you say, and when he says you, he means me. When David said years 4 or 5, does that mean 4 or 5 years after closing, which will be 12/31/2025? Yes, that's what I mean. So, I mean, if we close December 31st, meaning we don't accept more money, and that's going to happen, then you as an investor can expect cash flow from refinance or operations, cash flow from operations, starting 4 to 5 years after that. That's what you can expect. And then there's another 5 years we have to hold the asset, which you'll be receiving cash flow from operations and depreciation to offset that. So thanks for the question. It's a great clarifying question.
On 28, Rob asked, will AI data center build-outs impact construction cost? I would say the immediate observations there are no. I would think Phoenix is actually a perfect example. So I don't know if any of you are in the Azola project, and there's other projects that we are going to be breaking ground on in other funds there as well. But Phoenix probably is one of the highest economic development markets just in the country. There's 30 projects that are over $1 billion in capitalization, ranging from semiconductor manufacturing to data centers there as well, both out east in Mesa as well as west in Buckeye. And on the projects that we're building there currently, we're seeing $2 to $3 million of savings on our buyouts. So Phoenix is what I would say a city from an economic development perspective that's at max capacity, and we're still seeing construction cost savings on those projects. So I'd say the immediate observations are it has not had an impact to date.
Excellent. We have one more question. It's from Blaine. Before I answer it, I want to thank Jacob. Thank you so much for your time. He literally, Jacob, how many days a month are you on the road? I mean, is it 15?
It's usually 3 weeks a month, and it's 1 to 2 cities in each of those weeks, right around there.
Yeah, and I will tell you that when we're together, which is quite a bit, he's an expert on every city. It's unbelievable. Not just the city he lives in, Denver, but Phoenix, Salt Lake, Vegas, the submarkets, the streets, the people, the relationships. It's really impressive. So thank you for joining us. You're probably on the road now, is my guess, somewhere. Are you in Denver or are you somewhere else?
No, well, I am in Denver for a brief moment until we're headed back to Chicago for Thanksgiving. So
there you go.
It's a brief moment at home just to pack again, unpack and repack.
Well, I really enjoy working with you. You know that, and you inspire me to keep going. It's people like Jacob, and it means a lot that he's been here 8 years. So I'm going to answer the last question. It's Blaine. Does Origin self-perform property management? Phoenix, for example, is very competitive, et cetera. Blaine, no, we don't. We do not have integrated property management. That was a decision made 15 years ago. Now we've gotten to scale where we probably could do it. But at the time, we had 500 units in 12 different cities, right? So 6,000 total, we'll say. That's not enough scale to have an effective property management team and to provide the training and the room for growth and retention and all the things. So it was an easy decision. But I will say what we've become, because now we're quite large in the number of units and the leverage that we exert, we can select the best property managers for a region and a submarket. And I'm going to actually, Jacob, what's the group? It's 2 first names that we use in Phoenix.
It's Mark Taylor, and I was going to
Mark
jump in
Taylor.
after you were done because I think that's a perfect
Yeah.
example
So
of
Mark Taylor's great. I mean, they're the best in Phoenix high end, and that's what we're building, right? So if you want to, that's what I mean by it's not just a submarket. It's a city, a submarket, and then like an asset class. So if you want to have Class A in the best parts of Phoenix, it's Mark Taylor. That's who you use. There's no one close to as good. So we're using them, but then we also do other things. You know, we've been doing this quite a while now. Like what we try to do is, even though they're not our team, our employee, our payroll, we try to create contracts that allow us to have key managerial input, such as who is hired for senior positions, property manager, leasing, et cetera, how they're evaluated, how they're retained, if they're retained. So I think we kind of get the best of both worlds, where we can work with the best firms, but also we're very, very active managers in terms of getting what we need. Because I'll give you an example. We have a playbook. It's quite long. If someone wants it, we can send it to you, on how we operate multifamily. And it's very granular in every aspect. But I can tell you that playbook is only as good as the people you hire at the places that the renters are showing up. So if you don't have a great property manager, assistant manager, even leasing, but also maintenance, I mean, you need maintenance people that are responsive and professional and polite. If you don't have those things, the manual will not be implemented to the highest level. And so that's how we approach it. All right, I'm done. You have both of our emails. We put them there for a reason. If you want to reach out to us, do. There are a lot of great questions. I wanted to be mindful of your time. There's probably 4 or 5 that we didn't answer because I thought they were a bit redundant with the ones we did. But if you didn't feel like your question was answered, reach out to either myself or Jacob. We have 70 people here. I might respond. You might get a response from somebody else. We might schedule a call. So we'll definitely respond. And you know, the big theme of today is, if you're in the fund, you're getting a very high quality, diversified portfolio of 3 assets. That's the most diversification you could get at the current level of fundraising. If there's more fundraising, we'll add a 4th asset. The fund will be closed in roughly 5 weeks at this point, end of this year. Then it'll become a 10-year hold. So if you're in the fund, understand, like, that's when the clock starts ticking. If you're not in the fund, it'll be 10 years from essentially next month. And I think Jacob and I agreed that the vintage, nothing is certain in investing, but I feel very confident about this vintage in terms of the distribution. Like, if I'm looking at a distribution of returns, I feel good about what that distribution looks like. And then really in investing, I think that's the best you can do and hope for. Thank you for being a partner, and thank you for listening in. If you're entertaining being a partner, have a great holiday season. And you as well, Jacob, to you and your family.
You as well. Thanks, Dave.